Whether you are saving for a down payment on a house, a future wedding, or planning for retirement, investing into bonds can be a great way to earn a guaranteed income while reducing the risk on your hard-earned money. With that said, my name is Sully, and all I ask is that if you do find value in this content, that you consider hitting the like and subscribe button for future content like this. And so to get straight to it, let's first go over what are bonds. When it comes to bonds, think of them like a loan that governments or certain companies create in order to raise money from investors, people like you and I, where we pretty much give them our money and in return, they promise to pay us back a guaranteed amount of income. And when the bond reaches the end of its term length, which is also known as its maturity date, you will then get your original money back from them. And so to show a simple example here, let's just say that you saved up $50,000 with the goal to buy a house in 2 years. Well, if you let your cash sit in a traditional savings account like Chase, that pays a 0.01% of interest, which means after the 2 years, if you let it sit here, you would have roughly $50,000 and nothing would really change, and if anything, you would lose the value on your cash due to inflation. But let's say you put that $50,000 into a bond for 2 years that pays a guaranteed 5% annual interest rate. That means that each year you would earn $2,500 in interest, where most bonds pay out interest every 6 months, also known as coupon payments. And all that means is that for 2 years straight, every 6 months, you would receive a $1,250 payment, which would result in earning a total of $5,000 after 2 years, as well as getting your original $50,000 back. And so bonds like this are also called fixed income securities, which leads me into the next topic to discuss, that is about the different types of bonds. The first type that is among the most popular are US government bonds, where the first I'll specifically mention here are ones issued at the federal level by the US Department of Treasury. These typically cover bonds like Treasury Bills, short for T-bills, T-notes, T-bonds, and then savings bonds like Series EE and I-bonds. Now, I'll cover how to invest into bonds and what to look out for later in the video, but understand the differences here depend on the type of structure that you are looking for. For instance, with Treasury Bills, the duration of these bonds are between 4 to 52 weeks, and because they are so short, rather than getting an interest payment every 6 months with a typical bond, with a T-bill, you are simply going to get a discount upfront on the purchase when you get them to then get the full payment value back at the end. So if you were to buy a Treasury bill, rather than investing $10,000 into it, you would get an upfront discount, so you may invest $9,500, where after the full year of owning the Treasury bill, you would then get the full $10,000, which the $500 that you would have earned is the guaranteed return and would equate to just over a 5% annual yield. And then with the Treasury note, the government would be borrowing your money even longer, which is 2, 3, 5, 7, or 10-year terms, and in return, you earn interest payments every 6 months. So let's say you invest $10,000 into a 5-year Treasury note that pays 4% of an annual interest. That means after a full year, you would get $400, split by 2 payments that you would receive, which means every 6 months you would get $200. And at the end of the 5 years, when the bond matures, you would get the full $10,000 back, plus throughout that time you would have earned a total of $2,000 from interest. And then as far as a Treasury bond, which is short for a T-bond, this is very similar, but now the terms are going to be 20 or 30-year duration. And do know that even though the intention is to hold your bond for whatever duration you pick, you can sell them early, but depending on the price of your bond, you may not get exactly what you invested, which I'll cover more on that in the next section. But the next type of bond to know about is a Treasury inflation protected security, short for TIPS, that has a duration of 5, 10, or 30 years, where they are set up to protect you against inflation because the principal will change every 6 months, resulting in a fixed rate of interest that adjusts every 6 months until they mature. On the other hand, I-bonds are also fairly similar as they adjust the rates every 6 months based on inflation, but they are structured differently, where one aspect is the taxes, because with I-bonds, you wait to get all the money until you cash in the bond, which you have to wait at least 12 months, and to avoid any penalties, that has to be more than 5 years. Then if we look at EE bonds, you can see that they guarantee the bonds will double in value in 20 years, even if they have to add money at 20 years to make that happen. Then aside from the federal level, another type of government bond is a municipal bond that is issued by state or local governments, where the money can be used to fund public works, such as parks, libraries, bridges and roads, and other infrastructure, which the interest paid on municipal bonds bonds is going to be tax-free at the federal level, and if you live in the state that the bond was issued in, then you can also avoid state and local taxes as well. But because of that, they're typically going to offer lower rates. And then from there are also corporate bonds that are issued by companies in order to raise capital, where one of the most common types here would consist of investment grade bonds. And whether you're referring to corporations or governments, this simply means that these bonds have a lower risk of default and receive higher credit ratings by the credit agencies, which I will cover more on later in the video. And then another type are junk bonds, which represent bonds issued by companies that are financially struggling and have a high risk of defaulting or not paying their interest payments or repaying the principal to investors. Then there are convertible bonds that, based on certain conditions, can be converted into company stock, or callable bonds that are a type of bond that can be redeemed by the issuer before the stated maturity date. Just know that there are many more bonds that you could look into, such as international bonds, zero coupon bonds, mortgage-backed securities, or agency bonds, to name a few, which I will mention if you are one looking for more flexibility with your bond exposure and you want an easier time diversifying and adding them to your investment portfolio, you can invest into a bond fund that allows you to invest into hundreds to thousands of different types of bonds all within one purchase. Currently, the most popular option for this is Vanguard's Total Bond Market ETF with the ticker BND that has $125 billion in assets under management with a 0.03% annual expense to own it, which is something taken out of the fund over time. It's not something that you're going to have to pay separately, but BND also pays a 4.44% 30-day SEC yield by providing exposure to the taxable investment grade US bond market, excluding inflation protected and tax exempt bonds. But over the long term, BND has not achieved great annual returns. All in all, the choice comes down to the level of risk that you are willing to take, the duration that you are looking for, potential return that you could earn, and tax treatment that all play a major part in the decision. But speaking of risk, let's now move on to discuss bond prices and the risks associated. The first thing that you need to understand here is that if you are ever going to look to sell your bond early, the price that you could sell it for will be more than likely different than what you paid for it. This is simply because if interest rates change in the market, that can either increase or decrease the demand for buyers to buy your bond at the price that you paid for it. For example, let's say you buy $10,000 of a 10-year bond with a 5% annual interest rate. That means that you would earn $500 of income after a full year, and once that bond matures after 10 years, you would get the $10,000 back. But let's say after a few years into owning it, that interest rates were to rise to 6%, and new bonds are now going to be able to earn $600 per year. This would make your $10,000 bond at 5% less attractive to new investors on the secondary market, so you may only get $9,500 for your bond rather than the $10,000 if you were to sell early. But if interest rates were to drop to, let's say, 4%, that means $10,000 on a new bond would only pay $400 in income per year, and that means that your 5% bond may look even better now to buyers, and they may be willing to pay more, like $10,500. This may not seem significant, but at scale, this is a very important concept to understand. But to sum that up, all that means is that bond prices move in the exact opposite direction of interest rates. So if you think interest rates are going to drop, you would ideally want to lock in your savings before, and if the price of your bond becomes more valuable due to falling rates, you could sell it early for a gain. But all in all, when it comes to bonds, typically the longer duration that you seek out to buy, the higher the interest that you're going to get paid because of the additional risk and time that you plan to take by locking up your money in that bond, which is what's called a normal yield curve. This is what we typically see in the economy, but there are times that short-term yields may exceed long-term ones, which would be called an inverted yield curve. And so this could be due to many factors, like the Fed raising short-term interest rates, could be to fight inflation, and investors worrying about the future economy that would affect the supply and demand toward buying the different types of bonds. And so many studies actually show that the inversion of the yield curve, typically looking at the difference in yields between the 10 and 2-year US Treasury bonds, shows that if short-term maturity interest rates exceed long-term maturity rates, that it is typically associated with a recession in the near future. And although it's not a guarantee, it is important to understand the pricing structure of bonds and how it could affect your decision making. So knowing all this about bonds, let's now go over why you would even want to invest in them. For starters, when you look to invest into bonds, they are going to provide you with a reliable income stream that you can project forward. And because of that, they are considered to be much more stable and significantly less of a risk than investing into stocks. So whether you're looking to be very conservative with your investments or need to store cash for the future and still want to earn interest on it, bonds will allow you to safely preserve your capital, which depending on the types of bonds you buy, you may be able to get better tax treatments as well. And not just that, but they also provide great diversification for investment portfolios, where a common rule to follow here is called the 110 rule, which means you take your current age, let's say you're 30, and if you subtract that by 110, that would equal 80, and that means that among your investments, you would ideally want to target 80% toward stocks and 20% toward bonds. And yet alone, in the worst case scenario like a recession, bonds, if anything, will minimize the downside risk, where the more you lose, the harder it is to actually get back to break even. As you can see in this image, if you were to lose 50% of your portfolio in 1 year, that means you would need to gain 100% just to break even. Whereas if you spent all your savings on one stock that declined 90%, that means that you need to have it grow 900% just to break even, which is insane. All in all, when it comes to properly investing your money, everybody is different, but one of my favorite investors, Ray Dalio, says diversifying well is the most important thing you need to do in order to invest well. And so something interesting from Ray Dalio is that he has become very well known for his all-weather portfolio that is meant to help the average person get the best returns with the least amount of risk associated. As he states, there are 4 things that move the price of assets that are inflation, deflation, rising economic growth, and declining economic growth. And because he says there are only 4 potential economic environments, that you should have 25% of your risk in each of these 4 categories, not 25% of your wealth in each category. I'll have a direct link to this article in the description below if you want to check it out after this video, but from the portfolio that he recommends, it's quite different because he says to have the largest exposure to be 40% in long-term US bonds, 30% stocks, 15% intermediate US bonds, 7.5% commodities, and 7.5% gold. This structure has allowed the portfolio to only decline 3.9% in 2008 when the rest of the market was down roughly 50% from its peak. So whether you want a predictable income, reduced risk, or just a safe place to store your cash, bonds are a great choice to look into. And because of that, let's now go over how to invest in bonds. Please understand that there are numerous ways to buy bonds, and it all depends on the types of bonds that you're looking for, but one of the most popular options is through Treasury Direct. Now, Treasury Direct is an official website of the US government where they provide great resources and tools to purchasing US Treasuries. But another option I actually prefer even more, that has even more options and may be even easier to handle, especially if you already have an account, that is to purchase bonds through a brokerage firm like Fidelity, Vanguard, or Charles Schwab, to name a few. But be aware that for securities through Treasury Direct, they are going to be traded in increments of $100, where brokerage accounts are in $1,000 increments. Now, I made a ton of content about Fidelity, especially their Treasury bills, if you want to learn more about that, with exact steps and visuals on how to do so. But as you can see, these brokerages have pages specifically for fixed income securities like bonds, where you can see all the types that are offered and the best rates that are currently available for each based on the durations that you are looking for. I will also note that CDs are not considered bonds. They are considered a type of savings account that provides a fixed income to investors. And although they don't provide any tax benefits, you may very well be able to find higher yields, and especially if you're using a tax-advantaged account or have a low income, or you're in a state with low taxes or no taxes, they may very well be worth looking into to at least compare your options, which I made an entire video on CDs if you're also interested to learn more about them. But just for your sake, here's the page of Charles Schwab that shows their fixed income securities, and then also Vanguard that has a wide variety for you to choose from, and they're all going to be very similar. So a quick little tutorial for you if you want to buy this through a brokerage account. You would select the type of bond that you're looking to purchase, assuming that you have an account through that broker. And so let's say you want to buy a 1-year treasury. You'll also notice that because this is in the secondary market, which means you're buying the bond from someone else selling it, that you may be able to get a treasury note that may be expiring within a year of today. But as you can see below, there is a treasury bill option, and the biggest thing you'll notice here is that the coupon payment is 0 for T-bills because they are structured differently, where if we click buy, it will take us to a page to fill out how much we want to buy, and that with a T-bill, the asking price is under $100, because we get the discount up front. So let's say that we want to buy one bond that is $1,000. How this works is that if the price is 96.4, that means that you would actually invest $964, and then when the bill matures, we would get the full face value back, that is $1,000. Where if we look at a treasury note, the price shows just over $100 because we don't get a discount up front, because a Treasury note pays the interest out every 6 months to the investors, unlike Treasury bills that do not. But also know that when it comes to selling bonds like T-bills through a brokerage account, the process is pretty simple, and I wouldn't let that scare you away from investing into bonds. Plus, companies like Fidelity have great customer service, and if you're ever stuck and have any questions, you can call in and speak to a real person. But to avoid this from being super long, the last approach I'm going to mention here is buying bonds through a bond fund. You see, as I mentioned earlier, the most popular one is Vanguard's Total Bond Market ETF with the ticker BND, and this fund in particular has 11,379 bonds that you can get exposure to all within one purchase, which it covers many different types of US government bonds and exposure to ones with different credit ratings like AAA or BBB. And just so you know, bond credit ratings are assigned by credit rating agencies such as Moody's, Standard & Poor's, and Fitch Ratings to have the letter designations like AAA, BBB, CC, which represent the quality of the bond. You see, bond ratings below BBB are not considered investment grade bonds, but rather junk bonds. And so the lower the ratings, the more risk is involved and the higher the interest that you may be able to earn, where on Fidelity, you can see a corporate BBB bond that has a 20-year duration pays up to an 8.45% yield, and that's typically the risk associated because of an unstable institution. Now, if you don't fully understand the risks associated by investing into these, you would be much better off gaining exposure through a fund so that you can own hundreds to thousands of different types. And if you are interested in purchasing a bond fund, understand that you could get either a bond mutual fund or bond ETF. And if you're in a standard brokerage account where the account is going to be taxed, I highly recommend sticking with ETFs. If you want to understand why and exactly what the differences are, I'll have 2 videos that I created on this topic that I think you'll greatly benefit from. But as far as purchasing a bond fund like the Vanguard Bond ETF with the ticker BND, this fund, because it's an ETF, trades exactly like a stock, so you can buy it on nearly any platform that you invest on, where the process of buying or selling it is going to be the exact same as if you were to buy Apple stock or an index fund like VOO. So knowing all of that, let's now go over the things you need to be aware of. As I mentioned earlier, one thing to realize is the impact of interest rates on the price of your bonds, because if interest rates rise, the bond price may fall, and if you plan to sell it on the secondary market early, this may result in an overall loss for you. Besides that, be aware of the bonds with low credit ratings, particularly junk bonds, because there's more of a chance that the issuer might skip out on payments and, worst case, not even return your principal, which is known as a default. Besides that, also realize the right time and place for investing into bonds. For example, if you are young and able to take on more risk with long-term investments, at least for me, I would much rather be heavily invested into strong US stocks, particularly index funds, because they have historically proven to do very well for investors when compared to bonds over the long term. Of course, that is a personal decision, but do realize that if you are investing into bonds for the long term and have them in taxable accounts, that could lead you to a significant amount of tax shreg over time. This means that it could significantly impact your after-tax returns, and crazy enough, if you held the bond ETF BND in a taxable account for 10 years, if you are in the highest federal tax bracket, excluding state and local taxes, then your after-tax returns would barely even be above 0%, and you would have barely even made money. But as you near retirement and include bond funds into a portfolio, ideally you would want to keep them in a tax-advantaged account like a Roth rather than a traditional brokerage account. And do know that the income that is triggered within these investments is going to be ordinary income and not long-term capital gains. And so the choice for this truly comes down to understanding what is called asset location, where you can see some of the best tax-efficient investments in taxable accounts are small cap and large cap growth stocks, where tax advantage accounts could be best for high yield and global bonds. But besides that, if taxes are a concern and you need to safely store cash in a taxable account, remember that US Treasuries are exempt from state and local taxes, where municipal bonds are tax-free at the federal level and states as well if you purchase them within your own state. Because of that, the yields here are typically going to be lower, but if you're a high income earner in a high tax state, the benefit may very well be worth it. To show a quick example, let's say that you live in Georgia that has a flat state income tax at 5.49%, and assuming that you're in the 24% tax bracket, that means if you purchased $100,000 into a CD at 5%, that would equate to $5,000 in income, but if we factor in the taxes that have to be paid on that entire income, that means your after-tax tax return would actually be $3,525. Where if you purchased a municipal bond in Georgia so that it's completely tax-free, and let's say you even had a lower yield of 4% rather than 5%, that means that you would earn $4,000 of income on your $100,000 investment, which means that after factoring all the taxes here, your after-tax income would be $4,000, which is $500 higher of an after-tax income based on picking the right type of bond as far as tax structure and what suits you best. But depending on your income level and state, CDs may offer a better opportunity for you, where right now there is a 14-month no penalty CD, which means you can sell anytime, no penalty, that offers a 4.25% yield when compared to the best Treasury bill on Fidelity that is 4.05% for a full year. The differences are small, but depending on how much you have to invest and what your tax situation looks like, the higher yields may or may not always be the best case, and it's best to always be aware of the tax implications when it comes to picking the best fixed income security to place your money into. Now, if you have any questions at all, let me know in the comment section below, and don't forget that I made many other videos related to this type of content that I think you'll greatly benefit from, as well as my free learning guides and newsletter that I'll have linked in the description below. And while you're at it, if you are interested to compare these bonds with the rates on CDs that are currently available in the market, I'll have a direct link to the platform Raisin that offers solid high yield and no penalty CDs. End of the day, I want you to do what's best for your own position, but do know that certain links that I have in the description below allow me to earn a commission when you sign up and get started. So if you find an option that suits you well and you get started, it also helps me out and is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.